Welcome to the 2022 more in-depth annual review. I'm going to put a little bit less pressure on myself to say the words correctly and everything like that for this video. But I wanted to have a conversation around kind of major lessons that we took out of 2022 and maybe the potential directions we have to go in 2023. It was definitely on the bond side, we kind of expected it from the bond side because we knew interest rates were going to be increasing, but we didn't know how much they were going to be increasing by. We know that, an ideal-ish rate for interest rates to be in Canada is between that 3 and 4%. That'd be considered like neutral. It's not restrictive on the economy. It's not very lenient. Like, it's not encouraging a lot of growth. It's kind of that middle basis point that we would like to see, long term. And there's a little bit of evidence to show that that might be the way that it ends up going. If you've never seen a yield curve before, this is kind of what it looks like. And on the bottom here, we have 1 to 30 years, and what you would typically expect is the 1 year to be lower, and then you're rewarded for the longer that you invest, right? That'd be typical. What you're normally used to, especially if you're buying GICs and things like that. But notice here what Canada, so this is the Treasury yield in Canada, is doing. Actually, let's look at Canada overall. So these are yield curves in a bunch of countries on average. Okay, so what do we see? We see the short-term interest rates higher, approaching 5%, and then we see a pretty steep drop-off, after the first few years, and then more longer term, we're seeing around that 3.5% ish percentage range, and that's kind of the expectation. And even when we look at like CPI inflation indicators and things like that, what the projections look like, a significant returning to some type of normal over the next few years. But that really sets up two aspects that we could go over the next year or two. First of all, we could hit a recession, and I'm not talking like a recession on paper, right? Like an actual recession where we see it in the streets. A lot of people are already feeling the pinch when it comes to inflation, but outside of that, we haven't really seen a recessionary type scare yet, where tons of people are losing their jobs. We're starting to see a little bit more out of the US, where you see the big tech companies laying off workers and things like that. But there's still a lot of job postings out there. There's still unemployment is relatively low. But if we do see an instance where broad layoffs and things like that, we will see an impact in the stock market. So what happens in recessionary environments is that stocks will come down. The expectation for stocks will come down. Money will not be so readily available to these small growthy companies that are trying to raise money. So their growth won't be so much. Just across the stock market in general, we'll see a decline most likely. And what do we see on the bond side of things? Well, on the bond side of things, when stocks come down and the country tries to encourage growth, we will see them bring interest rates down. What do we know? Well, we know when interest rates come down, bond prices go up. And when interest rates go up, bond prices come down. And that's been very evident this year. So that's one way to go. So we hit a recession, that happens. Bond interest rates come down, stocks come down, which means bond prices go up. Okay. Other route is that they get inflation under control, and we hit this mythical soft landing that they seem to all be hoping for. That seems to be further and further out of reach. What happens then? Well, interest rates again would very likely start to come down. Again, we need a target long term. The market's expecting them to be like longer term to hit that 3.5 range. So what do we see when the bond prices will go up because interest rates are coming down? So that's kind of what we'd expect in the bond market. In the stock market, hopefully we wouldn't see that much. We wouldn't see a crazy rally, maybe. Although the stock market tends to follow what we think is going to happen versus what's right in front of us in the short term. So we could see a little rally on good news. Any good news is could potentially lead to a rally. But hopefully, fingers crossed, we wouldn't see a crazy rally. We'd see some type of normalization. Everything that happened in COVID was driven because of money being cheap and people having extra money. It caused supply chain issues. It caused all these issues, and it would be nice if we come out of this to avoid doing all that again. It would be nice for the supply chain issues to catch up and to fix themselves. We're already seeing a little bit of progress, but we still have more progress to go. It would be nice to see oil prices and energy prices stabilize, and that would mean that the stock market wouldn't be moving up 20% or down 20%. It'd be nice to see some type of stabilization throughout 2023. What we get, that's to be seen. But they're the two different routes that seem the most probable. Either we enter a recession and interest rates drop because of it, or we don't and we avoid it, and hopefully we take some time and there's some thought process because of the scare of higher interest rates and everything like that, to get back to some type of normality. Another thing that's been very interesting over the past year is the reemergence of value versus growth, and you'll see this theme across all indices, so all different markets. This is the US. The other one was Canada. There's been a debate, I guess, in my industry, I guess in finance, value versus growth, and this has been going on for a very long time. Value's dead, blah blah blah. You hear all of this, especially throughout COVID, when growth stocks were taking off. It's interesting though that the numbers don't really support that, and in an environment where stocks drop like they have, value typically always outperforms growth, and that makes sense theoretically, right? Like if you're the difference between value and growth is that a growth company, you're paying what you think it might be worth in the future. A value company, you're pretty much paying what you think it's worth today, because they typically don't have the same type of growth trajectory, that rapid growth trajectory that growth companies may or may not materialize. And that's the may not is kind of the key point here. So think of value as the tortoise in the tortoise and the hare scenario, and the hare is growth stocks. They're definitely more exciting. You get the big jumps like we saw with Tesla, where people made people millionaires, whereas value also makes people millionaires, just a lot slower. This is kind of like the Warren Buffett approach. But what you notice is that that there's like, when you look at the numbers between growth and value over the last 10 years. So over the last 10 years, growth has significantly performed value investing. When you go to like 25, 30, 40, 50, 60 years out, value it's not even a real competition. Like value has significantly outperformed. But everybody always questions, is this time different and this time different? And I don't have an answer to that. It's just interesting to see, that during these type of events, value does well. And that's why I don't like the whole high risk means you have stocks type way of thinking. Because you can have a medium low type risk type portfolio with very minimal bonds. It all depends on what you have in it, and yeah, the last year was definitely an ode to that. We in Canada, value went up, but it's just interesting. You see it across all the different markets. You'll see value did very well. Value is still underperforming over the long term. So depending on your goal, it depends on how you invest. But yeah, value did pretty well. Another thing of note is I obviously invest pretty heavily in the US. You kind of have to, and part of that part of the reasoning behind that is just Canada is such a small, very small part of the global market compared to the US. So bigger companies, you have a little bit more diversification, you have a little bit more choice, etc., etc. But it really speaks to why you should almost always be fully diversified. If you're in 100% Canadian stocks this year, you did well. You was laughing. You did really well. Yeah, I mean, most the Canadian market, a good chunk of people were down very little compared to the broader market. But when you look at the long term, just even if we take into consideration large cap here, so large cap in Canada over the last 10 years has done 8%. Large cap in the US has done 15.5%. So I'm not saying we should be 100% in stock in US or 100% Canada or whatever. It's just more reason to be diversified, and that's going to help going forwards. So a big takeaway from this year is just because an area did well. Sorry. Just because an area did well doesn't mean that you shift your entire investment philosophy to suit that area. And the same for if you're a low risk investor and you're heavily into bonds. Just because bonds did poorly this year, you certainly do not want to miss out on hopefully the end of this year or the beginning of next year when interest rates start coming down because it scared you because bonds are down X amount. It's very key to understand the nuances within the fixed income space and the bond space and how they interact with each other. So basically, this year interest rates were up, so bonds were down, and bonds were down a lot, especially for low risk investors. They haven't seen this type of down almost ever. So major event and major down for fixed income investing. Hopefully a good chunk of that will be reversed when interest rates come down though. And on the stock side, just because stocks did well, if Canada enters a recession, we have a whole lot more that we can drop versus something like Europe, where you're looking at I mean, it was a pretty dismal year for Europe, and it doesn't look like it's going to get any better, especially with the energy crisis. But yeah, just because Canadian stocks did well this year does not mean we now switch to Canada. There's still a lot of places that can be that could go down even further. So typically what you're finding I'm doing for rebalancing and things like that this year, unless we're needing money for we're starting to think about needing money for 2 years down the line for RIF payments and pension payments and things like that. A lot of this we're holding fast, we're holding steady, and then we're looking to reevaluate once the economy stabilizes, no matter what it does, whether it's into recession or on the other side. With bonds and stocks being down together, it's a very unique circumstance. Typically we'd be selling bonds because they're doing so well and buying stocks if it was in a recession. But that's not the case, and stocks didn't hold up that well. If anything, there's a big indicator to be more into bonds to take advantage of interest rates dropping. But even that, long-term returns of stocks still outweigh bond market returns. So it's more of a short-term thing. I'm not too keen on making too many short-term decisions, especially when it comes to investing. But anyway, hopefully that covers a lot of the information that happened hopefully that covers a lot of the information for that you have any questions. If you do have any questions, always reach out to me. It's definitely been a challenging year, and I don't think it's going to get any significantly better over the next little while. But provided we avoid a recession, things should stabilize. If we do hit a recession, then typical rules will apply. We've been there before. We know what to do in that case, and we will be buying stocks. We will be selling bonds in growth type investments to take advantage of down assets and bonds and companies that should recover and do well leading out of a recession. So anyway, if you have any questions, please let me know. Thank you and goodbye.